Hi, and welcome to Janken's Guide on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to look at how to model composite derivative strategies and use them to support the optimal execution of corporate strategies. And for more on derivatives, please consult my book, Corporate Foreign Exchange Risk Management, co-authored with Lars Oxelheim and Alf Alvinesen. There's also more information on riskbudgeting.se. And as they say here on YouTube, please like and subscribe. So the view taken on derivatives in this channel is that they can be used to facilitate the optimal execution of corporate strategy, meaning that you can make sure that enough funding is available to support the investment program, for example. It takes financing to be able to invest, and if you can't make sure that the adequate financing is in place, you might underinvest. And derivatives can be used to secure cash payoffs that help mitigate the underinvestment problem. You can also reduce the probability that you end up in some kind of financial distress, which is when you fail to meet your ongoing payments on debt liabilities. And that too implies several disruptions to the value creation process in firms as you become less competitive a firm. And so there's another role for derivatives. So this strategic view then, it calls on us to sort of use or evaluate derivative strategies in that context. And we're talking about composite derivative strategies here, which are combinations of different generic derivative positions. And the idea is to tailor or engineer the cash flow payoffs in such a way so as that to make them occur exactly when you need them the most for the purposes of investing or securing payments on debt liabilities, for example. So you can tailor or engineer your derivative cash flows for these purposes. So like I said, you put together combinations then of generic derivative positions, which is a derivative of a specific type. But there are many types, so that we can sort of combine them in various ways and thereby achieve exactly the kind of risk return profile we're looking for. So what you can vary then or choose from are these various kinds of derivative instruments that are out there. And you also choose to be on, whether it's going to be a short or long position, which I'm about to explain what that means. You also select a hedge ratio for each of these positions. And you can use different strike prices on each of them. And as you vary these things, you end up with different payoff profiles. And the trick is to select the one that is the best configuration with your corporate strategy so that you support it maximally. So here you have the 5 generic strategies. You have the short positions over here, which imply that you generate a cash inflow at inception, right? You receive the premium. But on the other hand, you're in for a possible payoff at maturity, right? You have to make good on that. So here you have the bought call option instead and the bought put option. They all generate payoffs when they reach the strike price. And when you buy an option, these payoffs are favorable to you, but for that privilege, you have to pay the premium upfront instead. And then you have the linear type of derivative, forwards, futures, etc., where the payoff is a linear function of the underlying reference rate or price. So what you do then is to combine them in various ways to generate these composite derivative strategies. So here you have 3 out of an almost unlimited number of strategies. There's really no limit here to what you can do in terms of the financial markets being so creative these days. And here you have the bear spread, for example. The two-way collar is a very typical or commonly occurring derivative strategy. Here's a three-way color where you add one more generic strategy to the composite strategy. So, and also pay attention here that we're looking at hedged revenue now. We take the perspective of a producer. So, and we're assuming 100% hedge ratio in these pictures here. So you can then have the sort of risk-return profile that you desire for your hedged revenue, as we call here, hedge, which is the commercial revenue plus the hedge payoff in this case. That's the definition of it. So you see the power of composite derivative strategies here in terms of allowing you to achieve the risk-return payoff that you would like. And to evaluate this in a strategic context, then, which is what we're advocating, we're going to do that in a corporate decision support tool targeting integrated financials and risk management. This is risk budgeting, which I've described in other videos, and it means that we have to add the possibility of evaluating composite derivative strategies to this risk model then. And the chart of accounts in this model is upgraded or enhanced, to cover the necessary lines related to derivatives. And so the cash flow statement, assets and liabilities and expenses are all have the right entry now to be able to accommodate derivatives in this model. So that it means that when you do this, set the model up in your spreadsheet. So we're talking fully integrated financial forecasts here. So these financial statements hang together with great analytical and accounting integrity. And that includes then these derivative lines, so that we model derivative payoffs and cash flows and gains and losses according to IFRS principle, keeping the model IFRS consistent at all times. All right, so what we're out to do here is to set up the model then so that it's capable of handling these composite derivative strategies. So this is, we're just revisiting the modeling of a single generic strategy, the put option here, the bought put option, and we're hedging a revenue risk in the fourth quarter. So the purpose of this hedging position is to generate an offsetting cash inflow in this quarter, right? And we set the modeling up of realized derivative gains here so that if the quarter and year are the indicated ones, you have this payoff function in place. And because it's an option, we're talking about a max function. It can never go below zero if you've bought the option, but you have exposure to favorable scenarios here, which in this case is when the strike price is higher than the spot price. That's when you're protected against further falls, and the option generates a cash inflow. And then you multiply that with the hedge volume, because this modeling is on a per contract basis. So the question is how many contracts or units have you hedged? And this is another input here. You select how much you're going to hedge. So what happens now as we move on to composite derivative strategies is that each of these generic positions has to have its own hedge ratio. And these are user selected, right? And the hedge ratio, another recap here, is hedge volume through exposed volume. So it ranges normally between 0 and 100%, which is when you cover your entire exposure and you've eliminated price risk. So that has to be selected for each of these positions that make up the composite strategy. And here's the same production as before, and there's a revenue risk now in fourth quarter. So we're going to enter a composite derivative strategy here, meaning that all these different generic strategies are on the menu. We choose from them. And in this case, we've selected non-zero entries for hedge volume for the bought put and the sold put. And we've chosen strike prices to go with that. That makes it a bear spread. So we're now executing in the model a bear spread in relation to this revenue risk. All right, here's another configuration. We're still buying puts, but we're now selling calls instead. So that makes it a collar. So now that is being executed, and strikes are entered accordingly, and the hedge ratio in both these cases is 100%. So we're hedging the same volume that we're producing. So that means a complete hedge of revenue risk on the downside, thanks to the bought put, but also that we're giving up a lot of upside here through the sold call. That's the implication of the collar. We're now saying that, look, okay, derivatives are fair value accounted, so meaning the model will have to mark to market or value them at each quarter end. So, and inception then, so that the model is going to keep track of the valuation of these derivatives. So we're taking fair value accounting seriously here, because we can't understand our financial forecasts unless we incorporate that feature. I mean, we're in for some serious surprises due to marketing unless we do. So equipping the model this way puts us in a place where we can be proactive and sort of anticipate these unrealized gains and losses from fair value changes. Right? So this means we have to use the appropriate valuation formulas. We then generate forecasts for these inputs, the inputs in this formula. And then using the formula, we just derive a valuation in each quarter going forward in the forecast. And that's typically Black-Scholes. You can be as ambitious as you want here, but we're using Black-Scholes for illustrative purposes. There's also a formula for the value of a forward contract. We don't do that here because we've covered that in another video. So basically, for whichever derivative you're talking about, there is a logical formula to use, which can be perfectly well implemented in your spreadsheet, which is what we do next. I mean, here we're forecasting. This is one of those support lines where we take care or generate some calculations that are necessary for being able to present these forecasted financial statements in a later step. So here, these are all inputs in the Black-Scholes formula, the classic ones. Here's the thing, all generic positions now have their own strike price. I mean, we're users, that's a user control, right, over that assumption. So these are numbers we've selected, and they're part of the forecast here. You don't necessarily have to forecast these things. You can also make reference to the very number you've chosen. But anyway, just for clarity, they're all lined up here in a forecast. We're saying that the interest rate and the implied volatility are going to remain constant. You can easily relax those assumptions and introduce a modeling of that as well if you're keen to make it even more realistic. But we're going to focus on the price risk here. And note that we're assuming a falling oil price here. And so that's important to see, because we're going to evaluate many different, possibly even simulating thousands of different scenarios here as part of our due diligence of these option strategies. And for now, we're assuming a falling oil price, and that we've put in place some of these composite strategies, right? So here's the bought put valuation. So we're just running these inputs that we just looked at through the Black-Scholes formula. That's done here. These are just steps that we execute as part of that, leading to a valuation of each, put option contract that we bought as part of the collar. And because the oil price is falling in this scenario, we're seeing a favorable development in the value of each of these contracts. So here we're basically in the money 1 quarter prior to the contract maturing, right? So we're in the money here. And this positive value reflects that this position has a very good chance of being, or ending up in the money. So the same thing is going on for each of these legs in the derivative strategy. Here's the sold call valuation. In this case, and same thing, we're just running it through the Black-Scholes in the way you would normally execute that formula. And the sold call here is losing in value because of the scenario that we've assumed. So it gets gradually less likely that this position could ever end up in the money. So when the price of oil is down here towards 40, it's a long way up, to the strike price of this position. So it's gradually depreciating in value over time here. All right, so that's the basic idea. We implement fair value modeling that way, and we then have long positions. We have to treat them in a specific way, and the short ones in a different way. It's a very similar way, but not quite the same. I mean, we are talking about cash outflows at inception because you have to pay the premium with a long position. You have the privilege of having exposure to favorable outcomes, right? That makes them derivative assets. Always, they can only have a positive value, because you pay for this premium, or you pay for this luxury of having exposure to good outcomes. So it can only get better from that point on, and in the sense of the downside being capped, right? So that it's an asset from that point on, and at settlement, it can either be a zero payoff or a cash inflow if you end up in the money, right? But nothing, it can't go negative. Whereas for short positions, it's the other way around, basically. You generate a cash inflow at inception because you're writing the put option, so somebody else is paying you for that privilege. And that makes it a liability. You're going to have to possibly make good on this claim, so that at maturity, we're talking about cash outflow or zero. Again, you have this max function round now, except that it's from the perspective of the buyer of the option, so it's going to be used against you. So it's going to be an outflow for you or zero. So here, for example, we're back with the beer spread to illustrate the fact that at inception we're talking about a cash effect as well. It's not just the eventual cash payoffs we're talking about. We have to keep track of cash in and outflows at inception as well. So we take the numbers generated by Black and Scholes here. This would then be the premium you would pay for these put options. Similarly, you receive the premium. You're on the receiving end here, and when you're writing this contract, you sell a call option means you write a call option, and that entitles you to a cash inflow as somebody else is paying the premium. So then this goes into the cash flow statement as an investment in derivative assets. So you receive this much, but you pay even more. So on a net basis, you're investing, you're paying for to execute this derivative strategy. And but this is important to see where we're investing here. It's not cost in that sense of the word, because we're creating an asset, which is what I'm going to show in the next step. So yeah. So another thing to be said is that here we're taking care of this in the fourth quarter, as if this is the last thing that happens in the fourth quarter, and then we have the entire next year is being forecasted. If you so prefer, you could have this occur on the first day in this quarter, in which case this line here will be part of the forecast. So that's a matter of taste. So, but in this case now we're just assuming that it all takes place on the last day of the preceding year. So that entering Q1, these are already in place here. So these are now assets and liabilities. Bought options are assets and sold options are liabilities. So that we model here you see the fair value of these contracts, which we get by taking the previously modeled value per contract, which is bought put valuation then, times the hedged volume, which is indicated or given by your hedge ratio times the production volume. So you connect those two. And if you have bought any call options, those two would enter here, because that's going to be an asset as well to you. And on the other side of the balance sheet, the other side of the balance sheet, you have the derivative liabilities. where the sold options appear. You have the sold put valuation here on a per contract basis, multiplied by the sold put hedge volume, which is again controlled by the user as in the form of a volume assumption, hedge volume assumption. And also this goes on as we revalue market to position to market, like we just saw there, that will generate changes in the value of the position, and these go into net income, right, according to fair value accounting. So you link those up to net income, this account here, unrealized derivative gains losses, which are essentially fair value changes, and you then also do that for realized derivative gains and losses. You have to model those as well. And now we're talking the ultimate cash payoff from these positions. So all the generic strategies or positions appear here. You would normally also include the forward, but we're omitting that for ease of exposition. Anyway, when the contract matures, you model the payoff as follows. For depending on which contract we're talking about, the max function will look slightly different. So for put options, the strike being larger than the spot price always implies a payoff, right? And the other way around for call options. But the important thing is also to remember that we have to flip the sign here on these short positions, because they can, from our perspective, there are always going to be cash outflows at inception. So that is important to see. We have to keep track of the signs. And that goes for changes in derivative assets and liabilities as well. Because, for example, here, if you have a derivative liability that decreases in value, as it does here for us, the call option is sort of gradually losing its value, that's a gain to us. Whenever a liability is decreasing in value, that's a gain. So we need to have that reflected in the sign here in the income statement. And also hedge volume, I ran out of space here, so I couldn't get into there, but all these are on a per contract basis, right? So we have to multiply them by hedge volume as well. And now we see them all appearing in the right places in the financials forecast, right? So we're first of all taking care of things at inception, getting the position in place. Here you have the put options bought and the call options sold here. Since there's a difference between them, that is going to have a negative impact on cash. We're starting out with zero cash, so cash is going to be negative here, somewhat unrealistically, but it's just for clarity. Also, we are modeling the payoff here. We are reversing any unrealized gain and loss when the contract matures, as always. Instead, entering a realized derivative gain and loss according to the previously calculated payoffs on these different positions, right? And another interesting thing to notice is that if you sum this line here, it turns out to be equal to the premium here. There's a built-in loss here on the unrealized derivative gain loss line, because you have created a derivative assets that has to unwind, But on the other hand, you're in for a possibly positive payoff here. So that is where you get compensated for that, and more hopefully. But you could have, if you end up out of the money, what happens is that this net asset that you created here will unwind, and sort of when it expires worthless, there's no asset left, and yeah. So that's how it works, but it's all balancing, and we're now ready to move on and evaluate lots of different scenarios and lots of different strategies, right? So here, this down scenario here was the one that we had activated. We could now switch to an expected scenario or an up scenario and see how these derivative strategies fare in each of them, just to make our due diligence, right? Just to get informed about how these payoffs and financials look in different scenarios, etc. And you can possibly do simulations of many, many more scenarios. And you can switch to other strategies. I think this is a three-way color in a way. Here the volumes are varied and they have different hedge ratios now. So endless possibilities here in terms of creating the kind of strategy that makes sense to you and supporting strategies that way. All right, so to sum up, what we've done here is to model composite derivative strategies by combining then different generic derivative positions. And you can, in that fashion, engineer almost any sort of risk-return profile, at least in the short to medium term. And to model them, we have to have user control over hedge ratio assumptions. We have to do valuations for each of these generic positions and payoff for each of them, so that they add up to the composite strategy. And we can do this very flexibly within the context of forecasted financials. These self-balancing models provide you with great security, right? When everything balances, you're doing things right, and you can link it up to strategies and investments and business plans, and that's the proper context for derivatives, right? So, all right, thank you for listening. Please check out my books. More information on riskbudgeting.se. Please like and subscribe, and have a good day.